Today you'll hear from Professor Jeremy Siegel, Wisdom Tree Senior Investment Strategy Advisor, and the Russell E. Palmer Professor of Finance at the Wharton School of the University of Pennsylvania. Professor Siegel has written and lectured extensively about the economy and financial markets. He's a regular contributor to the financial news media. He has received the highest teaching rating in a ranking of business school professors conducted by Businessweek magazine. So Professor Siegel, we're all very excited for this presentation titled On the Economy and Markets and COVID-19. Nobody's here to listen to me speak. So without further ado, I'm going to pass it off to Professor Siegel. Thank you for joining us today.
Thank you very much, Eric. Thank you, Leah. I'm very happy to be with you. I'm going to tell you my views on the economy and why and what this means for the markets. And then we're going to take your questions. My most well-known book is the one on the right called Stocks for Long Run, 5 editions. Sold over 500,000 copies, all told. The most important graph in that book you're going to see, first of all, I have to go through, of course, a couple of disclaimers. Our legal group makes sure we put all these in here with definitions and what to expect. But now we're going to get to that most important graph, total real returns. What do we mean by total real returns? We mean the returns on these asset classes in the United States after inflation, including all capital gains and dividends. In the case of stocks, interest, coupons, and capital gains or losses also in bonds. So take a look at this. $1 stocks, I've gone back further than anyone else. We almost have 220 years. That's how your stocks would grow. $1, almost $2 million after inflation. This is bonds. This is treasury bills. This is gold. Notice gold only stays a little above inflation, and this is the depreciation of the value of your dollar. And on the left over here, you will see the real returns, the average annualized real returns on these asset classes. Stocks over 220 years have averaged 6.8% per year after inflation, dividends plus capital gains. We're not going to be that high in the future, and I'm going to talk about that. Bonds have been 3.6, and whoa, we are going to be much lower than that. Treasury bills, which are bank accounts also, 2.6, way lower than that. Negative numbers, by the way, for those two. Gold will not do as well as stocks, but I think gold is going to do better than bonds. And the dollar is going to continue to depreciate, and it is my belief it's going to have depreciated at a much more rapid rate. Now, let me just give you 20 seconds on my background. I got a PhD in economics at MIT with a specialty in monetary theory and policy. My first teaching position was at the University of Chicago, where I was colleagues with Professor Milton Friedman. I'm sure many of you have, or all of you have heard, expert in monetary theory and policy, in fact, received the Nobel Prize. He impressed on me how important the money supply is for not only the economy, but also the financial markets. Now, what I'm showing you over here is a graph that I was looking at last summer. This is a graph of the money supply. M1 is actually checking accounts, payroll accounts, debit accounts. And I said to myself, wow, from March, when this pandemic began, through June and July, the money supply jumped 40%. I had never seen anything like that before. By the way, I went all the way back to the financial crisis 12 years earlier. And in the whole year following the financial crisis, the money supply had only gone up by 20%, less than 20%. So I said to myself, wow, we're going to have a boom in stocks. And we're also going to have more inflation. By the way, just to show you, our increase, this compares it to the rest of the world and other developed economies, was more than twice the increase that I saw in the rest of the world. Also means that our dollar is going to go down in value, and has. I remember going on to CNBC last summer saying we're going to have inflation in 2021. We're going to have higher interest rates, not by the Fed, but in the long bonds. Anyone see what's happened today? For a few minutes, the 10-year US Treasury bond hit 1.6%. By the way, many people didn't even predict that by year end. I had predicted already 2% by year end. Now, even that might be too low. We'll talk about that later. When I went on the air last year and talked about inflation, whoa, did I get blowback? Dr. Siegel, have you been looking at what's been happening to oil? You know, down, you know, I remember it crashed to zero, below zero. Look what's happening, commercial rents. They're crashing, on and on and on. I said, yeah, you just wait. Yeah, those, you know, commercial real estate is going to be challenged for a long time, but you watch everything else next year. Once the vaccines come online, and once the economy opens up, you're going to see inflation. Now, let me make something very clear. I do not mean hyperinflation. I don't even mean inflation like the 70s. I don't even mean high single-digit inflation. But I do mean inflation of 3, 4, 5% that might persist for 2 or 3 years. And that's more than double the rate that we have had over the last 2 decades. And let me show you another chart. This chart appeared a month ago in an op-ed piece that was written for the Financial Times of Britain. They emailed me back and saying it was the most cited article in the newspaper on that day. This is the M2 money supply, yearly growth. M2 is a broader money than M1 because it includes all savings accounts and banks and money market mutual funds. And take a look at where we are. That is the highest level of growth in 2020 that we have in the 150 years of data. By the way, most of this data was collected back in the 1960s by Professor Milton Friedman and used in his just legendary book, Monetary History of the United States, which was cited by the Nobel Prize Committee in awarding him the Nobel Prize in Economics. I also want to show you this little bottom graph because that shows you the deviation between growth and inflation. You see, inflation usually follows money growth by anywhere from 6 to 18 months, sometimes 2 years. So we're also at a record deviation of liquidity from inflation. Again, I'm not talking about, you know, super high inflation, but I'm talking about inflation that we have not seen for a long, long time. Now, what does this all mean? First thing, I get the following blowback. Dr. Siegel, did the Federal Reserve engage in quantitative easing, you know, increasing the reserve supply dramatically after the financial crisis? And yes, I heard all sorts of cries about inflation, and it didn't happen. You know, now you're crying inflation. What makes you so sure we're going to have it this time? By the way, I was one of the economists that did not call for inflation the last time. And you know why? Because most of the reserves that were created by the Federal Reserve last time ended up as excess reserves in the banking system. They were not lent out, or only a small fraction. We have a very different situation today. Today, the money that's being created by the government, really financed by the Fed through buying all the debt, is going directly into the pockets of consumers and businesses through the stimulus checks, through the payroll protection program, through the grants to states and localities. They're just putting money in people's accounts. That's the difference. As Professor Friedman told me, he said, Jeremy, the money that the Fed creates as reserves is very important. But if those reserves move into the money supply, M1 or M2, you've got a real powerful stimulus in the economy. All right. Again, this is, as I said last year, first into the stock market and then roll right into the economy. Causing inflation, I think 4 to 5%. Now, can't be precise on this. Also, I think the Fed is going to let it roll down. You might say, just a minute here, Dr. Siegel. Isn't the Fed say we're going to let it go a little bit above the target? Yeah. A little bit's going to turn to a little more, to a little more, to a lot more, because they want to run this economy hot. That's clearly the purpose. We don't need this stimulus plan that, by the way, we hear it's going to be passed tomorrow. Already $1 trillion of the previous stimulus plan hasn't even been spent. They want it to run really hot. We'll talk about one of the reasons why they want to run it so very, very hot, but they want to run it really very, very hot. And by the way, the Fed has the levers to control inflation, but not on a tick-by-tick basis. What do I mean by that? It's not, Janet Yellen, and I respect her very much as a very bright. I know her. I was actually the first person to interview her at a huge venue when she stepped down as governor, chairman of the Federal Reserve Board of Governors. She said, we have the tools to control inflation. Yeah, those tools, yes, but they're not tools. It's not like driving a car where, you move the steering wheel a little to the left and it goes immediately a little to the left. You put your foot on the brake and immediately the car slows down. We don't have tools like that. There are long and variable lags between the tools and the economy. Oh, we can slam it and get any inflation down. I mean, Paul Volcker certainly did that in 1979. But it is not a tool that's at all with precision. So they're going to run this hot, then they're finally going to tighten, and that may not be to the end of 222, 223. And meanwhile, they'll let the inflation run in the economy. Now you say, oh, wow, what does that mean? What do I do? Is stocks good there? Well, you know what? Stocks are very good in moderate inflation environments. Yeah. Stocks, remember, are claims on real assets. I mean, land, property, capital, machines, plants, trademarks, copyrights, intellectual property, on and on. These are real assets. As prices rise, these real assets will rise. Now, not always 1-to-1, sometimes more, sometimes less. But the evidence that I gathered very convincingly over the long run, stocks are one of the very best hedges against inflation. Probably land is the only thing that even really comes close to it. So stocks will do well in a moderate inflation. They don't do well in a high inflation environment. And the reason for that is because the Fed is going to eventually slam on the brakes. But don't worry about that yet. I mean, both Powell and Yellen have told us they're not ready to do this quite yet. I mean, Powell knows if you want my opinion, and I have not expressed this before, but Powell, I think, knows this stimulus is too much, but I think he's keeping his criticism down. And the reason for that is that I think he wants to be renominated by Biden as chairman next year when his term comes up. And I think that's very important. Now, remember, actually, the Federal Reserve is actually one of the few institutions where parties have let other members of the party, Powell's a Republican, rule over it. Clinton and Obama, let Greenspan continue a Republican continue to rule over it. It is so important that it is seen as nonpartisan, but it is important. I mean, I respect Powell. I think he's playing a little coy here. I think he wants to be renominated, and if what happens is going to happen, I think he will be renominated, and it would be good to have them be chairman again. That's why he's muting his criticism. If he didn't want to be renominated, I think he would be on board saying this stimulus is just too much. All right, now, are you guys worried about valuation? You think the price earnings ratio of the market, which is the most important measure of valuation, you think we're overbought? Well, not really. Let me show you. Now, this is a plot of the price earnings ratio in the S&P 500 since 1954. So we have almost 70 years of data here, 65. Gone up and down. It's been as high as 30, right over here. That was a tech bubble. We're nowhere near that. We're in the mid-20s. We'll talk about that. But I want you to notice, do you notice that the trend is upward? And it hits 20 today. Actually, I almost think that 20 is like the new normal price earnings ratio of the S&P. We're a little higher, and we'll talk about the consequences of that. All right, so what does this, you say, all right, PE ratios, what does that mean for returns today on the market? Well, let's get to this. Next slide. If you want to convert returns convert price earnings ratios into returns, you take the price earnings ratio and you flip it. You take the reciprocal of it. That's called the earnings yield on the market, earnings over price. It turns out that the earnings yield on the market is an excellent predictor of long-term real returns on stocks. So let me give you the other statistic. I mean, if we have earnings on the US stock market for 150 years, from about 1870, the average PE ratio in the market since 1870 has been 15. 1 over 15 is what? 6.7. Now, if you remember that very first slide I showed you, what was the long-term real return on stocks? 6.8. That's not a coincidence. It's good. Well, we won't go through the finance of why that's true, but it is absolutely true. So we have to pay attention to price earnings ratio. So when I did this exercise, now we're a little bit lower now with this little sell-off the last couple of days, which we'll talk about. The S&P 500 is about, well, when I did this on February 21st, 3890. That was 22 or 23 times this year's estimate of operating earnings on the index, which are now estimated 171. Now, my opinion is that's too low. I think we're going to be above it. By the way, that's a month ago, we were 165. Now they're 171. I think we could easily be 175 or 80. Let's take 171. So we're between 22 and 23. So if we take the earnings yield on that, 1 over 22 is about 4.5%. So when people ask me, Professor Siegel, when we look ahead 3 to 5 years in the market, what is your prediction for the real returns on stocks in the US? And I say around 4.5% per year. Now, after inflation, which is going higher, right? After inflation, dividends plus capital gains after inflation. What do you get in bonds after inflation? Well, we're at a 1.5 today on the 10-year bond. If inflation is 2.5, you're -1. Well, Doctor, you could say, Dr. Siegel, can I just go to the TIPS market? Inflation protected government bonds. Yeah, you know what you get there? -0.7, -0.8, negative. In other words, the government has no means to even guarantee you just the rate of inflation on your investment. Think about that. There's no way to even guarantee that you'll get zero return after inflation. They'll guarantee you get negative return after inflation. So the difference between stocks at 4.5 and bonds at -1 or worse is about 5.5%. Now, given that the historical average is 3 to 3.5, I think this is pretty good, right? The advantage of stocks over bonds, which, by the way, we economists call the equity risk premium, is actually almost double the long-run historical average. I do want to also say one reason why the price-earnings ratio should rise over time is not just because interest rates are low. That could be one reason, but also because the liquidity of the market is so much higher. You guys can index over broad, internationally and domestically, so much more efficiently and a lower cost than you could during the 19th century when the PE was 15. As you all know, a straight indexed investment today can be had for 5 basis points, 6 basis points. Professionals can get it for 2 basis points. Wow. So that was never available before. Now, when you have higher liquidity, you have higher prices. Does mean lower returns. Well, when we say 6.5% in the 19th century returns on stocks, do you think the average investor got that? Or even in the first half of the 20th century? No way. I mean, because of transactions cost, it probably got 5. 5 is consistent with a 20 PE ratio. Do you see why the PE ratio rises? When liquidity rises in the economy. All right, and we are a little bit higher than that, again, because interest rates are so very, very low. And by the way, even though interest rates are going up, and they definitely are, and I'm going to talk about that, they are not going to be rising to the old levels. And especially on your bank accounts, because Powell's going to keep that Fed funds rate at 0 until the employment goal is reached. What is that? That's something new the Fed has added. Well, full employment, as defined by who? The Democrats, the Biden administration? They're not going to get down to 3.5% that Trump did. So what, are they going to try to strive for that? Run the economy hot for how long to try to even get down to where we were before the pandemic? No. By the way, tech is driving some of the higher PE. This top graph over here shows you the PE of the market, and this particular, the blue graph 20 is the entire S&P. But if you take out the tech sector, it's 21, which is really that's backward looking too. Very reasonable. And by the way, if you go to other parts of the world, so this is the bottom slide here is international. That middle one that says 19.6, that's IFA. IFA is the world, the developed world outside the United States. And the light blue line at the bottom is the emerging markets. 17 PE. Really the best values in the market today. Now you could argue less growth, but in terms of valuation, don't give it up. We'll talk about that a little later. What about value and growth? Finally, I think we're seeing it. We're really seeing that turn. Now, I started showing this graph in November to some clients and advisors. It is the relative price earnings ratio, forward looking, on value stocks and growth stocks. We've had 3 peaks where growth stocks have had very high value. First one was back in the Nifty 50. You need to be kind of near my age. I don't know how many of you out there remember the Nifty 50 back in the 1970s. That's when the institutions said, I don't care the price, I'm just gonna buy the blue chips. Like, you know, IBM and Procter & Gamble, and then others which they thought were blue chips, like Eastman Kodak and Polaroid and Avon Products, and yeah, a lot of them didn't turn to be as blue as they thought. The second big bubble, of course, that everyone talks about was the internet bubble and technology bubble 2000. Now, I want to make clear when I say, you know, that we are now, as you see this last part, in that valuation range. I do not expect a crash of tech to be like 2000. I don't even think it will crash. I just think it's going to underperform. You have to remember that back in 2000, over here, the price earnings ratio of the tech sector of the S&P 500 was 80. What is it now, 40, 35? And that was, by the way, in a much higher interest rate regime. So was that overvalued? That was crazy overvalued. Now, I don't think tech is crazy overvalued. I'm not going to say every stock is not overvalued. But if you take a look at history here, you'll see, yeah, this could be the time where value turns. Who's paying for the war on COVID-19? You ever ask that question? Isn't it interesting that, like World War I, you know, World War I, remember when the pandemic began last March, everyone went back to 1918, started talking about it. And they all said, and my city, which I'm sitting in right now, Philadelphia, was hit the hardest. And you know one reason it was hit? Because we were having a parade, a war bond parade, to fight. In other words, the government was raising funds to help our boys fight the war in Europe, World War I. A war bond rally called Liberty Bonds. That's how we used to raise money. Has anyone asked anyone to raise money? They raise money. You know what the old ways to raise money is? You run bond programs and you raise taxes, and then you pay for what you have to pay. Oh, not anymore. The Federal Reserve buys all that debt. Don't have to worry about it anymore. Who do you think is going to be paying for the war on COVID-19? It's going to be the bondholder through inflation, which is going to eat up the value of his and her bonds over time. And if you go through history, and I've done that, that's often the way. We're never paying off debt. We're never paying off government debt. We're just inflated away. Right? So now, this little dot that you see coming up there, we've hit the level, the previous high, which is right at the end of World War II. And we're going to be going up from there. Is our government going to do anything about that? Let me say something that I've been lecturing on for 10 years. The government will not do anything until interest rates, long-term interest rates, rise enough to harm the economy. And people say, ouch. And home builders say, ouch. And mortgage borrowers say, ouch. We're not there. We're not anywhere near there. Can we get there? Yeah. Don't hold your breath. It's going to be quite a while. You think the 10-year 1.5 or even 2 or even 2.5 is enough to cause people to scream as long as the economy is going so strong? No, that's not going to happen. And that's all right. Hey, you guys might have been hearing about, maybe you have 60-40 stock bond portfolios. It's been the classic mix. I mean, people run it because, first of all, they want enough income and gain to maintain their lifestyle. They don't want to run out of money. Now, that's important, especially if you have a retirement portfolio where you're not earning anything outside your savings. And if you can leave a legacy, fine. And I want to be tax efficient. The only problem is, and I put only in parentheses because it's a big problem, bond interest rates are too low today to make the 60-40 bond stock portfolio viable. Let me just show you a little graph that we did here. We studied this in Wisdom. We actually did this right before COVID. We took a 30-year portfolio. Someone trying to live off a 30-year portfolio with 2 different types of draws, 4% a year and a 5% draw a year. Could be a retirement portfolio, at 60, planning, to go to 90 or as long as you can live. And then we calculated by running thousands of simulations using actual stock and bond market returns. What is the probability you're going to run out of money with different stock bond allocations? All to the left is an all bond portfolio. Well, bonds are so, are giving you so much. In fact, if you only are in tips, you'll never, if you're 100% tips, there's like no way you can even do a 4% draw. You can do a 3.3% draw every year because I was 30 years with a 0 return. As you add stocks, the probability you're going to run out of money goes less and less and less. But this is interesting. For a 4% draw, it is minimized at 75% stocks, 25% bonds. If you have a 5% draw, now that's aggressive. Because that almost doubles the probability you're going to run out of money to about a third from about a sixth. But it keeps on going down the more stocks you have. In fact, 100% stocks, less probably you'll run out of money than if you have bonds. And why is that? Because the bond interest rate is so low. So 60-40 is dead. You got to move more aggressively today. All right, here's my last graph. I'm going to summarize it. The liquidity of the Fed and government policy is going to ensure a really strong economy and strong stock market this year. I think value stocks are going to outperform. Yeah, it's been a long. Whew. Yeah, we value investors have suffered a long time. I will not deny it, but I have the feeling in our bones the time has come. Reopening of the economy and the search for yield. Where are you going to get it? Dividend-paying stocks. You're not going to get it in the bonds. Now, the average dividend in the S&P is only 1.5%. But if you take these sound dividend-paying stocks, and we at Wisdom Tree have quite a few very diversified dividend portfolios, low cost, 2.5, 3.5. If you go internationally, you get 4.5, 5.5. Yield, not even talking about capital gain. And remember, yields from stocks are basically protected against inflation, not in the standard government bonds. Okay, Fed is going to keep the short rate near zero. I already said so. Powell wants to, garner favor with Biden and the Dems. He's going to let the inflation run well above the 2% target before thinking of tightening. Bond yields will rise substantially. Last year on CNBC in August, I said that the 40-year bull market in bonds is over. I even said I didn't think anyone watching this program will ever see yields lower than what we saw last year. I said this last year. Actually, I didn't even think our children will ever see it. I think it's going to be an all-time low. I think as decades and decades go on, we're going to look back and say, what were those people thinking buying government bonds at 1% for 10 years, 20 years, 30 years? They were crazy. Yeah. By the way, even more crazy than it's very much like right after World War II. Remember we built up all that debt and bonds were only 2%? And then we started having inflation, what's called post-war inflation, strong economy, post-war inflation, great stock market. People were still holding on to their 2% bonds back then. But looking back, and then interest rates went up and their bonds went down and down, and then their purchasing power went down and down. Last year, I said on TV, on many programs, that Treasury bonds are going to be the worst performing asset class in 2021. Absolutely. Listen, we're in a different world. Technology has been enhanced, but let's face it, it's been priced into the market. It's great. It's great. But I'm not going to be paying 100 times earnings for a lot of those. Business travel is going to be very permanently impaired, but leisure travel, wow, boom, second half, 2021. Productivity is rising. Profits, as I said, are going to exceed expectations. And yes, I am sorry to say, we are going to have a tax increase this year. Second reconciliation bill. This was the first. I hear that Biden wants to pass it. First reconciliation tomorrow, or at least in the House, maybe the Senate too. We don't need that. But the second one is going to have the corporate tax increase and personal tax increase. Now, the good thing is it's not going to be all of Biden's program that he put on his website. We're going to get about a half of it, and a lot of it will be delayed until 2022 because he doesn't want to impair the recovery this year. But yeah, everyone be prepared for higher taxes. Keep your international allocation. Pressure is going to be on the dollar with all this liquidity. I know international investing has not been rewarded over the last 5 years. Just like value investing has not been rewarding over the last 5 years. But history tells us that markets turn. And when relative valuations reach the level that we have reached late last year and early this year, it's time to shift into those stocks that have not enjoyed the tremendous rise of the past. That, I end my formal comments, and I am very happy to take your questions.
Well, thank you so much, Professor Siegel. That was so relevant to the questions we are all thinking as advisors and investors. So thank you so much for your insights. Definitely creating a lot of questions here on our panel. We're at the point where we're going to start taking and addressing those questions. We see a lot of really good questions. Remember, you can still submit your questions. Just go ahead and put them in that Q&A icon down below on your screen. And so now I'm going to pass it on to Eric and let him ask Professor Siegel some of those questions and hear what Professor Siegel has to say. Eric, all yours.
Thank you, Leah.
Sure, thank you, Leah. And thank you, Professor Siegel, for that great presentation. So Leah's right, we've had a lot of great questions coming in. And we also got some questions beforehand from the audience. So first off, I'm going to touch on something you didn't speak to directly. But can you speak to cryptocurrencies, their growing acceptance, and your opinion on their long-term place as a global asset?
Yes, and that's usually the first question. I'm going to make a couple comments here. We have the technology today to have people transfer between merchants and consumers, between people. You know, I want to give you $30, you want to give me $30, click, click, through the banking system at virtually no cost, 2 or 3 basis points, which are hundredths of a percentage point. We have a crazy system set up with credit cards, where a credit card charges merchants 2.5%, then they give me 2% back in cash. And then they say to the merchants, you can't discount cash. You know, you can't surcharge it because we charge you. Which I think is wrong. I think it's a restraint of trade. This opens, you know, let's do alternatives. But you know, Bitcoin cannot compete as a payments mechanism with what we have today, especially if we liberalize the ability to do debits at 2 or 3 basis points between accounts. All we need is a little bit of competitive legislation to get that started. Number 2, and all your advisors out there know this. You know, I've had to take courses in money laundering and all that to make sure that cash isn't used for illegal purposes. Are we doing that with Bitcoin? No, we're not. If we put the same regulations on Bitcoin that we have on everything else, and the same tax regulation, you make a $100 gain on a stock, you get a statement at the end of the year from your brokerage firm to the IRS. You get that for Bitcoin? It's tax evasion not to report it. By the way, you're not. It's not the institution's responsibility for you reporting. You have to report it whether they send you the form or not. You have to report a Bitcoin gain whether anyone sends you a form or not. In other words, I'm just going to end with this. If you just enforce current rules against money laundering, against tax evasion, current rules, and liberalize our financial system, if those 2 or 3 things happen, Bitcoin would fall 90% from its current levels. Now, I'm not saying it's going to happen. But I'm not talking about even new laws. We're just talking about existing laws. If Biden says, okay, we're going to collect taxes and prevent money laundering and all of this, go. I don't think it's a medium of exchange that can compete with the dollar if we just have a few rules on the dollar of what we can do with it. Now, I'm not saying Bitcoin couldn't go to 100,000 or 500,000 or a million. It really can go, because if we still have all the craziness that we do, credit cards and the fees to the merchants and inefficient that, you know, people can keep on going higher and higher. I'm just saying that I do not think it is the medium of exchange of the future for whatever else it might have. That's all I'm going to say.
Great, thank you. We had a couple questions on the minimum wage impact on inflation, and I think this one sums it up. Could the proposed $15 minimum wage have an inflationary effect on the economy compared to the other components you mentioned?
Sure. But it now looks to me that the 15 wage, yeah, or let me tell you what I think the deal was just done in the last day or two. I bet what Manchin's against the 15 wage. He says, listen, so the Dems say, listen, I know you think that the 1.9 trillion is too much. Let's do a trade-off. We'll drop the minimum wage. You accept the 1.9. And that's how they're going to ram it through reconciliation tomorrow. So we're not having the 15. And then we'll deal with that later. And we'll probably have something like 10 or 12. I think Manchin said it'll go for 12, and then a gradual rise in the future. Yeah, it is inflationary. And by the way, inflation then reduces the minimum wage. You have 10% inflation, then the 15 becomes 13.50. It's another, you reduce the debt, and then you reduce the minimum wage. So yeah, it is inflationary, but I do not think we're going to get now the 15. I mean, there may be a year out where there are going to be some goal on it, but for 2021 or even 2022, no, there's not going to be a national $15 minimum wage.
Great. Next question. Are there any particular industries that you would stay away from for the next 6 to 24 months, given what's going on in the current and future economy?
Well, I'm not really someone that picks sectors. I'm a macro person, so I shun away from picking actually stocks and sectors. I do think that, in a rising interest rate environment, financials can continue to do very well. And as I said, technology is absolutely wonderful, but it's fully priced. I'm not going to comment on energy. You guys down there know more about oil than I do. It's been, I don't know, anyone thought we could be $62 as early as February. Wow. I will say the following. Energy independence is extremely important for the United States. And I'd be very upset if Biden did anything that lessened that energy independence that we have. I mean, I think the fracking revolution, in my opinion, was one of the greatest revolutions that we had over the last 20 years. And he may try to shut it down on some federal land, blah, 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 blah. I know he's getting a lot of pressure there, but it has made us energy independent and has been absolutely fantastic for our economic independence and our political independence from the Mideast.
What are your thoughts about real estate versus stocks?
Real estate's going to be good in this environment. Let's face it. Real assets in an inflationary environment are good. So, yeah. And we've seen a big rise in housing prices and land prices. I think they'll continue to go up. Yeah, I like that. Now, REITs, of course, in stocks, they're the good REITs, that house warehouses for the cloud, and then there are bad REITs, which are commercial tenants, which I think is going to be really harmed. So you got to know what you're doing, even though they trade as one class, as you know, is the new 11th industry that was invented from the S&P 500. So you got to be careful about what you go into. But as an asset class right now, I think stocks will do better than real estate on an average, but I think real estate is looking good to me over the next couple of years.
Okay, great. What portions of the fixed income market would you focus on for that piece of the portfolio, given the current low yields and potential for inflation?
Well, first of all, because taxes are going to rise, and keep your eyes on munis, but I would stay short term in the sense, like, don't put yourself out 20 or 30 years or 10. You don't want to lock yourself in to a 2% muni when next year that same muni is going for 3% and you're locked in for 10 years. Stay short so you can deploy into the short-term munis, so you can deploy into higher yields as they occur into the future.
With the changes politics regarding the current administration, including potential regulatory and tax changes. What do you expect to see in the short and intermediate term as far as the U.S. economy in general?
Well, I think, as I said, we're going to have a corporate tax increase and personal tax increases. However, the profits are going to be so good that it's going to overcome them, and we're going to have a good stock market. So, basically, I think that Biden administration said we're going to run this economy really hot. It'd be really good for firms, and we're going to take some of this back. But it's not going to be enough back to slam the market. But do expect it's going to be the second reconciliation bill. It's going to come with the infrastructure bill. And that's when we're going to see the tax increases. And we're going to have them. I wish we didn't, but political reality is we are going to have tax increases that I think comes with the second reconciliation bill, which will be the infrastructure green, bill, if you will.
Great, thank you. A little more detailed question here. So given technology's explosion and overall market cap the past decade, which has resulted in a proliferation in the value of intangible assets, which aren't accurately reflected in many traditional valuation metrics, has the way you look at equities changed over time to reflect this phenomenon?
Oh yeah, first of all, book value is a stupid concept now as a basic of value. I never liked it. It's worse now than ever because it doesn't contain intellectual property and all the rest. I'm a value investor. I prefer to use earnings or dividends. I don't like to use book. And by the way, that also understates a lot of the profits. Basically expenses on technology. A lot of that should be capitalized, which would actually make profits higher than they are, and then depreciated over time. So it actually could say to understate the profits of the corporations too. So yes, it definitely, you have to realize that, intangibles are the source of wealth today in the market. It's not machines and plant and equipment the way it was in the middle of the last century.
Great. What do you think about active versus passive management, both in equities and in fixed income?
Well, we at WisdomTree are basically indexers, but we're not capitalization weighted indexers. We are what's called fundamentally weighted indexers, which means we tilt towards indexation, yes, and very broad diversification, but not just based on the value. We don't just, say automatically Tesla's right because that's what the market said. We take a look at earnings and then decide, on a formula basis, how much Tesla to include. So it's still an index, but it's what we call a smart index. I think that's the way you got to go today. It just don't accept, capitalization weighted indexing is saying current valuations are right. So broadly diversify according to the market level. And we say no. We say that markets often overshoot on both sides. And we're not judging it, saying and looking at this and looking at that. We have a formula, a very simple formula about we weight according to the earnings. We weight according to the dividends. I think that's what you need to go in the future. Now, again, as I said, this does tilt you towards value, but that's what I think where you want to be today with this tremendous run up that we had last year in these tech stocks. Much deserved, but now fully priced.
All right, well, we appreciate you answering the questions, and I think we're about out of time here. So Thanks again, Professor Siegel, for your time and the great presentation. And we really appreciate all the insights. And to our clients, thank you for your time as well. And we hope you enjoyed the presentation. So if you signed up for the webinar, you'll be receiving a link to the presentation in your email after this. And like Leah put in the chat, we didn't get an opportunity to get to all the questions, but our advisors and our staff at TCG will work to follow up on those questions. So once again, thank you very much, Professor Siegel. And
Thank you.
Appreciate it.
Hope to see you again. Good afternoon.
All right. Have a great day, everyone.